Welcome back to the deep dive. This is where we try to take those really complex topics and just boil them down, give you the core insights, right? Without all the noise.
Exactly. That aha moment we're always chasing.
Yeah, that's the goal. Because listen, you're curious, you probably already know a fair bit, but you want to go deeper, efficiently.
Right. Cut through the clutter.
And today, investing, wealth building, but maybe not just the 101 version everyone recites. We want to look at the real foundations, perhaps with a slightly different lens.
Get beyond that initial, maybe intimidation factor that finance often has.
Definitely. Finance, it can seem scary, all that jargon flowing around, but today we're aiming a bit higher than just definitions.
Yeah, about refining the understanding you already have, I think.
Exactly. Making sure you walk away feeling, well, truly equipped, more confident. Okay, let's unpack this.
Indeed. And the source we're diving into today, Investing Basics for Beginners. It's interesting. It was originally for English learners.
Right. Which sounds almost too simple, maybe?
Well, that simplicity is actually its strength. It lays out the absolute foundational concepts with remarkable clarity. But our mission here isn't just to repeat those basics back to you.
No, definitely not.
We're going to use this straightforward framework as a kind of springboard to extract, deeper implications, more nuanced understandings that will resonate with you, someone who's already engaged with this topic.
Turning simple definitions to something more robust.
Precisely. Actionable insights that hopefully elevate your existing knowledge. So by the time we're done, you won't just nod along with terms like investment, stocks, bonds, risk, diversification. You'll grasp their broader significance and how they really interact in the real world.
Yeah, absolutely. This deep dive isn't about spoon-feeding you terms you might already, have a handle on. It's about empowering you with a more precise, a more comprehensive understanding. That's what really underpins financial confidence, isn't it?
It really is, building that solid bedrock.
Yeah, for future opportunities, making sure you're not just informed, but strategically well-versed. This kind of knowledge, it's directly applicable. It can impact your financial landscape, like starting today. Here's where it gets really interesting. Because the true power, I think, isn't just knowing the words, but understanding the dynamics behind them. Okay, so let's start right at the beginning. It might seem super basic, but the answer holds, well, profound implications. What exactly is investing?
Right.
Our source gives this beautifully simple definition: putting your money into something to make more money in the future.
Sounds almost too simple, doesn't it?
It does, but that simplicity, it just scratches the surface of a really powerful and honestly often misunderstood mechanism.
It absolutely does. And that definition, simple as it is, immediately makes us ask the big why. Why invest? Why not just, keep your money safe in a savings account? Or, like the old joke, under the mattress.
Right, what's the real driver?
Well, for someone like you, already familiar with financial ideas, the core insight really lies in understanding the corrosive power of inflation. That's key.
Ah, yes. The silent wealth killer.
Exactly. When you just save cash, its purchasing power just erodes over time. Prices go up, right, for groceries, gas, everything.
That $100 today definitely won't buy the same amount in 10 years.
Not even close. Investing, on the other hand, is the deliberate act, the conscious choice to put your money to work. The explicit goal is generating returns that actually beat inflation.
So you're not just treading water, you're actually moving forward.
Precisely. Growing your wealth in real terms. That's the critical difference between holding static cash that's silently losing value and actively putting that capital to play so it can expand.
And that expansion, that's where things like compounding come in, right?
Oh, absolutely. The power of compounding is, well, it's almost magical. It means your money doesn't just earn a return. Your returns then start earning returns.
It snowballs.
It creates this exponential growth curve over time. Just think, Put away, say, $1,000 today. Let it sit for 30 years. Even with a, let's say, modest average return of 7% a year.
Which is historically achievable, though not guaranteed, of course.
Right, no guarantees. But that $1,000 could potentially grow to almost $7,600.
Wow.
That's not just earning more, it's earning on your earnings. That insight alone, it really shifts your whole perspective on how wealth is actually created over the long haul.
That distinction, saving versus investing, fighting inflation, harnessing compounding, it's huge, foundational. And our source, it immediately points to the classic example, stocks.
The one everyone thinks of first, usually.
Yeah. Defined simply as buying a small part of a company. You become a tiny owner, a fractional proprietor, essentially.
Precisely. And how stocks grow in value? Well, it's much more dynamic than just some vague notion of value increase. It's tied directly to the company's success, its future prospects.
Okay, so how does that work? What makes the value go up?
Well, when the source says a company makes more money, it implies real business success. Strong sales, efficient operations, maybe they launched a hit product or expanded into new markets.
Tangible stuff.
Exactly. It's reflected in financial metrics, things like higher earnings per share,
Yeah.
EPS. Consistent growth can boost the company's market capitalization. That's its total value in the market's eyes.
So, what investors collectively think it's worth?
Right. And then there's investor confidence. Good news, strong leadership, positive market sentiment. All that affects how much people are willing to pay for a share of that company.
So, it's partly fundamentals, partly psychology?
A big part psychology, yes.
Mm.
So when you buy a stock, you're not just buying a piece of paper or, a digital entry. You're buying a claim on that company's future earnings, its assets, its potential.
And if the company does well,
Then that success translates into the potential for you to sell them later for more money than you paid. It's like buying that tiny slice of a pie. If the pie gets bigger and tastier, your slice becomes inherently more valuable.
makes sense. Is that the only way stocks provide returns? Just selling higher?
No, that's a great point. There are actually two main ways. There's that capital appreciation, the stock price going up.
Mm-hmm.
But many companies also pay out dividends.
Ah, right, sharing the profits.
Exactly. A portion of the company's profits paid out directly to shareholders, usually quarterly. So you can potentially earn not just from the stock's growth, but also from a steady stream of income. It adds another dimension to the return potential.
Okay, so owning a piece, potential for growth, maybe some income, sounds pretty good.
It can be, but, and this is a crucial but,
Here it comes. Our source points this out immediately, and it's so important. But investing is not always safe. There is something called risk. This means you might lose some or all of your money. This isn't just small print, is it?
absolutely not. It's fundamental. It's the necessary counterpoint to the potential for gain. What's fascinating here is how early and directly the source introduces risk. It's not an afterthought. It's presented as inherent to the whole process.
Okay, so risk. We know it means potential loss. But let's unpack that a bit more. What kind of risk are we talking about?
Great question. Because for someone who's already familiar with the basics, the deeper insight is realizing risk isn't just one thing. The possibility of losing money exists because, well, the future performance of any investment is never guaranteed.
Right. No crystal balls.
None whatsoever.
Yeah.
So we can break risk down. Think about unsystematic risk. This is sometimes called company-specific risk.
Like something goes wrong with just that one company.
Exactly. A product recall, bad management decisions, a lawsuit, a major competitor disrupts their market. Things unique to that firm, or maybe its specific industry.
Okay.
This is the kind of risk that diversification, which we'll definitely get into more detail on later, is specifically designed to combat.
All right. So that's one type. What else?
Then there's systematic risk. This is often called market risk. It's the risk inherent in the overall market or the economy.
Ah, the big picture stuff.
Right. Think of a major economic recession, like 2008, or a global pandemic,
Yeah.
or significant geopolitical events like wars or trade disputes.
Yeah.
These things tend to affect almost all investments to some degree.
So even if you pick great companies, the whole market could drag them down.
It's precisely. And even a really well-diversified portfolio can't entirely eliminate the systematic risk. It's just part of being invested in the market.
Okay, so company-specific risk and overall market risk. Got it.
And the source really nails the takeaway here. The key is to learn about different types of investments and make smart choices to reduce your risk. Notice it says reduce, not eliminate.
Good point.
It's not about avoiding risk entirely, because if you did that, you'd likely avoid meaningful growth too. It's about understanding its different forms. It's about knowing your own time horizon, how long you plan to invest for.
Like decades versus a couple of years.
Exactly. And understanding your personal risk tolerance. How comfortable are you psychologically with seeing your investments go up and down?
That's a really personal calculation.
It absolutely is. A younger investor, maybe someone with decades until retirement, they might be able to stomach more volatility. They could lean towards more aggressive, growth-oriented investments, knowing they have time to recover from any short-term market dips.
Makes sense. Time heals market wounds sometimes.
Often, yes. But someone nearing retirement, their priorities might shift dramatically. They might focus more on capital preservation, keeping what they have safe, and maybe lower volatility investments that provide steady income.
Less focus on hitting home runs, more on not striking out.
That's a good way to put it. So this early introduction of risk, understanding its facets, it really sets the stage for making informed decisions. It turns uncertainty from something scary into, well, a strategic variable you can actually manage.
All right, with that crucial groundwork on investing and risk laid out, let's shift gears slightly and dive into what our source calls important vocabulary.
The building blocks.
Exactly. And this section, it's incredibly valuable, not just for, memorizing definitions, but for equipping you, the listener, with the precise language you need to navigate the investment world confidently.
It helps you feel part of the conversation.
Totally. So you can discuss strategies, opportunities, understand articles or reports, rather than just feeling like you're on the outside looking in. It moves you from conceptual understanding to, well, a more articulate grasp. So let's circle back to that foundational term, picking up on the idea of putting money to work. Investment. The source definition is simple. Money you put into something to earn more money later.
Yes. And while that's the absolute core, the kernel of truth, for someone like you who follows finance, the deeper insight here is really drawing a clear line between saving and investing.
Ah, okay. People use those interchangeably sometimes, don't they?
All the time. But their primary goals are actually quite different. Saving, think of your emergency fund or money for a house down payment next year. It's fundamentally about preserving your capital for short-term needs.
Safety first, and you need to be able to get it quickly.
Exactly. Liquidity, easy access, and safety are paramount. It might earn a tiny bit of interest, maybe, but its main job isn't growth. And often, like we said, inflation actually eats away at its real value.
Okay, so saving is short-term preservation. What about investing then?
Investing is about growing your capital, specifically over the long term. It's a deliberate strategic allocation of your funds into assets like stocks, bonds, real estate, whatever, with the explicit aim of generating returns that significantly beat inflation.
So the goal is actually increasing your real wealth.
Precisely. And to do that, you consciously take on some calculated amount of risk. You accept some potential downside for a greater potential upside.
So that basic savings account at the bank, technically it fits the put money in to earn more later definition.
Technically, yes, at the most basic level. But the intent behind it, the expected outcome, and the risk profile place it at a completely different end of the financial spectrum compared to buying stocks or investing in a business.
Right. Low risk, low potential return, mainly for safety.
Exactly. So this really raises an important question for you to consider. Are your current savings actually working towards your long-term goals? Or are they just sitting there for short-term safety, potentially losing purchasing power? It forces you to think about the purpose of each dollar.
That's a really sharp distinction. Intent matters.
Mm.
Okay, moving on. We touched on stocks earlier. Let's dive a bit deeper. Simple definition again. Small parts of a company that you can buy.
Right. And the crucial thing to really get your head around here is the multifaceted nature of the ownership that comes with buying stock.
It's more than just a number on a screen.
Much more. You become a shareholder. You own a tiny piece of that company. And that comes with certain rights. You might get to vote on corporate matters, though, honestly. For small investors, it's often symbolic. More importantly, you have a claim on the company's future earnings and assets.
Okay.
And the source says when the company grows, your stocks become more valuable. We talked about how that growth isn't abstract. It's tied to real business performance, innovation, market expansion.
Right, the fundamentals. Earnings per share, market cap.
Exactly. But also, as we mentioned, the value can grow because of investor sentiment, market trends, broader economic tailwinds. It's this dynamic interplay.
So business health meets market perception.
A great way to put it. And don't forget the two potential return streams. Capital appreciation, the price going up,
Okay.
and dividends, those profit distributions. So owning stock gives you a stake in the potential upside of a business in multiple ways.
Okay, clear. Stocks, ownership, growth potential, tied to performance and sentiment, maybe dividends. Now, the source introduces another major player, bonds, described as loans you give to a company or the government.
Fundamentally different, right?
Fundamentally different. And understanding this difference clearly is absolutely paramount if you want to build a balanced, resilient portfolio.
Okay, so how do bonds work exactly? I'm lending money.
You are literally acting as a lender. You buy a bond, you're giving money to, say, Apple or the U.S. Treasury or your local municipality for a set period of time.
Okay. In return for that loan, the source says they promise to pay you back with a little extra money called interest.
Right, the compensation for lending them my cash.
Precisely. Usually, this is a fixed payment, often called a coupon rate, that you receive periodically, maybe twice a year. This continues until the bond reaches its maturity date.
And at maturity.
At maturity, you get your original loan amount, the principal or face value back.
Okay, so regular interest payments, then principal back at the end. Seems straightforward. Is the interest rate always the same?
No. The interest rate or yield depends heavily on a few things. A big one is the borrower's creditworthiness.
How likely they are to actually pay you back?
Exactly. Is it a super stable government like the U.S. Treasury? Or is it a startup company with a shakier financial footing?
So higher risk borrower usually means higher interest rate offered.
Generally, yes. They have to offer a higher yield to compensate lenders for taking on more risk of default, the risk they won't pay back the loan. A U.S. Treasury bond will typically offer a much lower yield than a corporate bond from a less established company because the default risk is perceived as almost zero.
Makes sense. What else affects the yield or value?
Big one. Interest rate changes in the broader economy. This is crucial. When overall interest rates in the economy rise, newly issued bonds start offering higher yields.
Okay.
Which makes your older bond, the one you already own with a lower fixed coupon rate, suddenly look less attractive, right?
Yeah, why would someone buy my old low-rate bond when they can get a new one paying more?
Exactly. So the market price of your existing bond will likely fall to make its overall yield competitive with the new higher rates. Conversely, if interest rates fall, your older bond with its higher coupon rate becomes more valuable. This is known as interest rate risk.
Wow. Okay, so bond prices move inversely to interest rates. That's important.
Very important. So if we connect this to the bigger picture, stocks represent equity, ownership. They aim for capital growth, maybe dividends, generally higher risk, higher potential reward. Bonds represent debt, They typically offer more predictable income through interest payments, generally lower risk than stocks, but usually with less potential for high growth.
So they play different roles in a portfolio.
Absolutely.
Right.
Bonds can act as a kind of ballast, potentially providing stability and income when the stock market is choppy. They offer a different profile for managing risk and generating cash flow.
Okay, stocks versus bonds, equity versus debt, ownership versus lending.
Yeah.
Got it. That distinction is key, which brings us back, inevitably, to risk. The source revisits it, reinforcing the chance that you could lose money when you invest. But how do we really unpack that for someone seeking deeper insights?
Yeah, this re-emphasis is so important because while the definition is simple for you, the knowledgeable investor, risk is, well, it's far from simple. It's not monolithic.
Right, we talked about unsystematic and systematic risk.
Exactly. And those encompass various factors that could lead to loss. For stocks, it might be the company performing poorly, declining sales, new competition, bad management. For bonds, even though they're generally safer, you still have default risk. The borrower just doesn't pay you back.
Especially with lower quality corporate bonds, maybe.
Right. And you have that interest rate risk we just discussed, rising rates hurting the value of your existing bonds. And then layered over everything is that market risk or systematic risk. The whole economy tanks, dragging everything down with it.
So risk is everywhere in different forms.
It is. And this is where the concept of volatility comes in. Volatility is basically a measure of how much an investment's price swings up and down over time.
Like how bumpy the ride is.
Perfect analogy.
Ah.
Higher volatility often implies higher risk, but it can also signal higher potential reward. Think of tech stocks versus utility stocks, often.
Much smoother ride with utilities, usually.
Generally. So the crucial point, the one the source drives home, and that really resonates. Risk isn't something to be avoided entirely if you actually want your money to grow meaningfully over time, especially beyond inflation.
Right. No risk, probably no real reward.
Pretty much. Instead, risk is something to be understood, acknowledged, quantified as much as possible, and most importantly, managed.
Eyes wide open.
Exactly. Being aware of the potential downsides as well as the upsides and building a strategy accordingly. If we connect this to the bigger picture, risk is just an inherent necessary part of the investment landscape. It's not some weird anomaly to be terrified of. It's a variable to be factored into your strategy.
Yeah.
And there's that fundamental trade-off. The higher the expected return you're aiming for, the more risk you generally have to accept. Understanding that relationship is key.
And that idea of managing risk, understanding it, it leads perfectly into the next big concept, diversification. Our source puts it so simply. This means don't put all your money in one place. Such a plain phrase, but wow, does it pack a punch for building financial resilience?
It truly does. It's probably one of the most fundamental principles of smart investing. And for our listeners, let's really break down the source's example to get the full insight.
Okay.
It says, if you put all your money in one company and it does badly, you lose a lot. Imagine pouring your entire life savings into one single stock. Maybe it's a super exciting tech company everyone's talking about.
Yeah, chasing that one big winner.
Right. And maybe it does soar for a while. But then, boom, a competitor launches something better. Regulators step in. Management makes a huge blunder. The company's fortunes plummet.
And your entire investment goes with it.
Potentially. You could lose a massive chunk, maybe even all of it. That vividly illustrates that company-specific, unsystematic risk we talked about. It's devastating when it happens.
Okay, so that's the cautionary tale. What's the solution?
The source offers the liberating counterexample. But if you put money in many companies and bonds, you lose less. This is the absolute essence of diversification.
Keep running it out.
Exactly. Spreading your investments across different asset classes, not just stocks, but also bonds, maybe some real estate, maybe commodities, things that tend to behave differently from each other in various market conditions.
So stocks zig when bonds zag, sometimes.
Sometimes, yes. They often have low or even negative correlation. which is great for smoothing out returns. But diversification also means spreading within asset classes. So within stocks, you invest in a variety of different companies.
Not just tech stocks, maybe some healthcare, some
Mhm.
consumer goods, financials.
Precisely. Across different industries. And ideally, across different geographic markets too, U.S. stocks, international stocks, emerging markets. You're creating this protective financial shield.
So if one area gets hit hard,
The impact on your overall portfolio is cushioned, mitigated by the potentially stable or even growing performance of your other investments elsewhere. It averages things out. It dramatically reduces the impact of any single bad investment blowing up your entire plan.
it's that classic don't put all your eggs in one basket idea.
It's exactly that. If that one basket drops, you lose everything. But if you have eggs spread across many baskets and one falls, well, it's unfortunate, but you still have plenty left. It's about building a robust financial ecosystem.
Right, but let's push that. Does diversification get rid of all risks?
Excellent critical thinking point. No, it doesn't. Diversification is brilliant at protecting you against unsystematic risk, the risk tied to a specific company or industry failing. But it won't entirely shield you from systematic risk.
The whole market going down.
Right. If there's a major global recession, even a beautifully diversified portfolio is likely going to decline in value, at least temporarily. But diversification makes the ride much smoother and significantly reduces your exposure to those specific, concentrated, and often avoidable risks. It's about managing what you can control.
Okay, we've really dug into the vocabulary now. Stocks, bonds, risk, diversification. We've laid the groundwork. So let's talk about action. How do you actually start?
The practical steps.
Exactly. This next section from our source offers a kind of practical roadmap, guiding you on how to start building wealth that means making your money grow over time. It breaks down what can feel like this huge, daunting task into clear, manageable steps.
Makes it less intimidating.
Yeah, transforms that insurmountable mountain into an approachable path for you. It's about building your financial tool set and actually embarking on this purposeful journey. And the very first step, maybe the most crucial and honestly sometimes the most understated in its power, is step one, save money regularly. The source simply advises, try to save a small amount every week or every month.
This step, it just underscores the incredible, often really underestimated power of consistency and habit.
It's not about having a huge amount to start with, is it?
Not at all. It's about the consistency of your contributions. The source says even a little money can add up. And that's not just some feel-good platitude. It's a profound truth, totally rooted in the mathematics of compounding we discussed earlier.
Yeah, the snowball effect.
Exactly. Just imagine setting aside, say, $50 a week. That might feel achievable, maybe skipping a few fancy coffees or packing lunch a couple more times.
Right, $50 a week, that's about $200 a month.
Right. $2,400 a year.
Mm-hmm.
Now, if you consistently invest that $2,400 every year for, let's say, 20 or 30 years,
Yeah.
assuming a historical average market return again, no guarantees of maybe 7–10%,
That relatively small, consistent amount.
it can snowball into a really substantial sum. Easily over $100,000, maybe significantly more, depending on the actual returns and the time frame. The real engine isn't the initial amount, it's the consistency of contributions plus the time for your money to earn returns, and then for those returns to earn more returns.
To discipline first.
That initial discipline of regular saving, it's like the fuel for your entire financial engine. It builds the essential foundation before you even start worrying too much about picking the perfect stock or bond. It's the difference between maybe a lucky one-off investment and a steady, reliable build that truly leverages the power of time itself.
Okay, powerful habit established. Save regularly. What's next? The source says. Step two, learn about different investments. It tells us to read about stocks, bonds, and savings accounts. Ask questions if you don't understand.
And this step just echoes the immense value of continuous active learning. especially for you, the listener, someone who proactively sought out this deep dive in the first place.
Right, you're already doing it.
Exactly. It emphasizes how absolutely critical it is to understand your options before you commit your hard-earned money. The financial world is vast, it's complex, it's always changing. There are countless investment vehicles out there.
Stocks, bonds, mutual funds, ETFs, real estate, crypto. It's a lot.
It is a lot, each with its own characteristics, its own risks, its own potential rewards. Understanding the fundamental differences, stocks for ownership and growth, bonds for income and stability, even how basic savings accounts fit your emergency needs. That understanding allows you to make choices that are genuinely aligned with your personal financial goals.
And your timeline and how much risk you're comfortable with.
Precisely. Your time horizon and your unique risk tolerance. This isn't just about passively reading a book either. It's about engaging critically with the information, asking yourself smart questions.
Like what?
Like, okay, how does this specific investment tend to behave in different economic conditions, like high inflation or a recession? Or what are the specific risks associated with this particular asset class or fund? What are the fees?
Connecting it back to risk again.
Always. Informed decisions are smart decisions. You wouldn't set off on a cross-country road trip without looking at a map or understanding how your car works, right?
Definitely not.
Well, similarly, you shouldn't be investing significant money without a clear understanding of what you're actually putting it into. This step, this commitment to learning, it truly empowers you. It transforms potential confusion or uncertainty into clarity and genuine confidence.
Okay, so save consistently, learn continuously. What's step 3? This one might be the hardest for many of us. Step 3, be patient. The source uses that lovely analogy. Building wealth takes time, like planting a tree and waiting for it to grow big and strong.
Oh, it's such a powerful and enduring image, isn't it? And it's absolutely central, maybe the most central element, to successful, sustainable, long-term investing.
Why is patience so critical?
Because it perfectly captures the long-term nature of wealth building. It stands in stark contrast to the constant temptation of chasing short-term gains or falling for those get-rich-quick schemes that are always popping up.
Right. Investing isn't a lottery ticket.
Definitely not. A tree doesn't shoot up overnight, does it? It needs consistent care, sunlight, water, good soil, and it needs time. Many seasons, years, decades to become that towering, strong entity.
Okay.
Similarly, your investments need significant time to let that compounding magic really work. They need time to ride out the inevitable market cycles, the ups and downs. They need time to benefit from the underlying long-term growth of the economy and the companies within it.
So patience helps you weather the storms.
Absolutely. Think back to major market downturns, the dot-com crash in the early 2000s, the 2008 financial crisis, even the sharp drop in early 2020. Investors who panicked, who sold everything near the bottom.
They locked in their losses.
Exactly. And they often missed out entirely on the subsequent recoveries, which historically have always come, eventually. So patience isn't just, a nice virtue to have here. It's a fundamental necessity.
A requirement for success.
It really is. It's the antidote to making impulsive, emotional decisions driven by scary headlines or social media hype or just your own fear and greed kicking in.
Which is very human.
Very human. But patience allows you to stick to your long-term plan, to ignore the short-term noise, and let the powerful forces of compounding and economic growth work for you over decades, not just days or months. Embracing this long view isn't just better for your financial returns, it's way better for your emotional well-being during those inevitable market bumps.
Makes total sense. Okay, so as we practice that vital patience, step 4 loops back beautifully. Step 4, keep learning and practicing, the source says. The more you learn about money and investing, the better your decisions will be.
And this just reinforces the idea that this is an ongoing journey, right? It's iterative, it's dynamic. Financial knowledge isn't something you just acquire once and you're done.
Right, the world keeps changing. New products, new risks.
Exactly. The financial landscape evolves constantly. New investment products emerge. Economic conditions shift inflation, interest rates, global trade. Your own life circumstances change too.
Yeah, what you need in your 20s is different from your 50s or 60s.
Completely different. What's relevant for a young professional laser focused on aggressive growth might be totally inappropriate for someone nearing retirement who's prioritizing capital preservation and generating reliable income.
So learning needs to be continuous.
Continuous learning, reading, asking questions, maybe even reflecting on your own investment experiences. What worked, what didn't, why.
Yeah.
All of that refines your understanding. It deepens your insights. It helps you consistently improve your decision making over time.
It's not just about facts, but about developing judgment.
That's a great way to put it. Developing financial acumen, strategic thinking. This step emphasizes continuous improvement and adaptation. It ensures your financial strategy doesn't get stale, that it remains robust, flexible, and always aligned with your current goals and the world around you. This is where your financial journey really becomes personalized, adaptable. It transforms you from someone just following rules into a more sophisticated, confident investor making informed choices for your unique situation.
Love that. Okay, finally, we reach what might be the most important guiding principle, a crucial piece of cautionary wisdom. Step 5. Avoid risky decisions. The source is very direct. Don't put all your money in something because it looks easy or fast. Smart investing is slow and steady.
Yes, this is such a critical warning. And really, it's kind of a distillation of all the previous advice rolled into one core principle.
How so?
Well, it connects directly back to our whole discussion about understanding and managing risk, right? And it reinforces the profound wisdom of diversification, that allure, that siren song of easy or fast money.
It's powerful. Everyone wants that.
It's incredibly powerful. It taps right into our desire for quick riches, for doubling our money overnight with hardly any effort. We see the headlines, we hear the stories, maybe about some meme stock or a new crypto.
Yeah, the FOMO fear of missing out kicks in.
Exactly. But these opportunities, these things that promise the moon easy or fast, they almost always come bundled with astronomical and often hidden risks. Risks that can lead to significant, sometimes even total, losses.
What are some common examples?
Oh, chasing hot stock tips you hear from a friend or see on the internet without doing your own research. Putting all your capital into highly speculative ventures you don't truly understand, maybe complex derivatives or obscure alternative investments. Or worse, falling for outright scams that promise guaranteed high returns, which almost always a massive red flag.
If it sounds too good to be true,
It almost certainly is. That phrase, smart investing is slow and steady, it isn't just some quaint, old-fashioned saying. It's a foundational principle backed by decades of financial research and countless real-world examples.
it pushes back against the get-rich-quick mentality.
It directly challenges that common misconception that investing is some kind of sprint to immediate wealth. Instead, it champions the disciplined, patient, long-term approach we've been talking about.
So consistent saving.
Informed choices based on a real understanding of risk and reward,
Strategic diversification.
and that invaluable virtue of patience, letting time and compounding do the heavy lifting. If we connect this to the bigger picture, these 5 steps: save regularly, learn constantly, be patient, keep practicing, avoid rash decisions. They form a truly comprehensive, risk-aware, and sustainable strategy. It's designed for building lasting financial success, not for chasing those fleeting lottery ticket type wins. It's about constructing enduring wealth with intention and wisdom.
Okay, so we've absorbed all these practical steps, the essential vocabulary. It's totally natural now to feel, I think, a mix of things. Maybe excitement, maybe some newfound confidence, but perhaps for some listeners, still a little bit of apprehension. Like, okay, where do I really begin?
Yeah, the first step, anxiety is real.
It is. But our source offers some really powerful motivation here and some tips to help you actually sustain this journey for the long haul. It wisely reminds us, remember, everyone starts small. It's okay if you don't understand everything right now.
That is such a comforting and genuinely empowering thought, isn't it?
It really is. It just normalizes the learning curve. Every single successful investor out there started somewhere, probably feeling unsure.
No one's born an expert. Every master was once a beginner fumbling around.
Right. So the source emphasizes the real key is to keep learning and practicing, and it adds both English and finance skills, which ties back beautifully to its original audience. But the principle holds for everyone. Keep learning, keep practicing.
It absolutely does. Acknowledging that starting small isn't just okay, it's really the only way to start. It takes so much pressure off. It shifts the focus away from needing to know everything right now and puts it squarely onto consistent effort and making incremental progress over time.
Little steps add up.
They really do. And to give you that compelling why, that reason to keep taking those steps, the source prompts you to think about your future. Imagine your money growing slowly, giving you more freedom and opportunities.
That visualization piece.
Yes. And I really encourage you, the listener, pause for just a moment right now. Truly paint a vivid picture in your mind. What could that more freedom and opportunities concretely look like for you?
What does it mean personally?
Maybe it's the financial independence to finally leave a job you don't love and pursue work you're truly passionate about. Maybe it's the freedom to travel extensively, see the world. Maybe it's being able to generously support causes or family members you care
Or
about.
just having a comfortable retirement without constant money worries?
Or simply that profound sense of peace of mind, knowing you have a robust financial cushion to handle whatever curveballs life throws your way, job loss, health issues, unexpected emergencies. This mental visualization, connecting your saving and investing efforts to tangible, deeply personal life goals, it acts as an incredibly strong motivational anchor. It transforms these abstract financial concepts into something real, something worth striving for.
That's incredibly powerful, and it connects directly back to the whole point of this deep dive, right? Moving beyond just understanding concepts to actually applying them in your life to achieve those goals.
Exactly.
And tying into those practical steps we just discussed, the absolute cornerstone for achieving that vision, it has to be consistency, doesn't it?
Without a doubt.
Our source highlights this virtue again. Try to be consistent. Save and invest a little every month. Over time, this will help you build real wealth. It links back so strongly to that tree growing big and strong analogy.
It does. It's the consistent watering, the regular sunlight, that steady nourishment day after day, week after week, month after month, that allows the tree to eventually flourish. It's not about one giant downpour followed by a drought.
No, it's the steady, sustained effort.
Precisely. Consistency is that often unseen secret ingredient. It's what truly unlocks and amplifies the power of compounding and long-term growth over decades. It's what transforms those small, regular contributions, the ones that might feel insignificant in the moment, into a truly substantial financial foundation over time.
So important to remember that when progress feels slow,
Absolutely. And as you embark on this journey or continue it, the source also wisely empowers you to seek help. It reminds us. Also, don't be afraid to ask questions and find help from experts or trusted friends.
so you don't have to figure it all out alone.
Exactly. Provides this perfectly balanced perspective. Yes, personal learning, taking ownership of your financial decisions, that's crucial. We've emphasized that. But recognizing the value of community, tapping into expert advice when needed, that can be invaluable for navigating complexities or just getting a second opinion to confirm your own thinking.
It's not about blindly following advice, though, right?
No, definitely not about blindly delegating responsibility. It's about informed collaboration. Maybe it means finding a reputable, fee-only financial advisor who acts as a fiduciary, someone legally obligated to act in your best interest, not just sell you products.
That fiduciary standard is key.
It is. Or maybe it's about seeking out high-quality, trusted online educational resources, books, or joining thoughtful investment communities. The key is learning to ask good, probing questions.
Like,
What are all the fees associated with this investment or advice? How did this recommendation specifically fit into my overall financial plan and goals? What are the potential conflicts of interest here? What are the realistic worst-case scenarios I should be prepared for?
being an engaged, critical consumer of advice.
Precisely. It acknowledges you don't have to go it alone, but you can judiciously leverage the knowledge and experience of others while always maintaining personal responsibility and critical oversight for your own financial future.
And so, wrapping up this section on mindset, the ultimate message here seems to be one of real empowerment and forward-looking optimism. Mm.
The source says, "You can do this. Your future self will thank you for starting today." It feels like a powerful call to action, doesn't it?
You really did.
Just a reminder that every significant journey, every big achievement, it always begins with that single intentional first step. And that step, taken today, maybe with this refreshed or deepened understanding from our conversation, it can have truly profound and positive impacts down the road.
Mm.
So what does this all mean for you, the listener?
Yeah, what's the takeaway?
It means you're now equipped, not just with the foundational knowledge, but hopefully with a deeper, more nuanced understanding, and maybe most importantly, the right mindset. That blend of confidence, patience, and commitment to learning to really begin or perhaps accelerate your personal investment journey. Hashtag toe check outro.
Wow. Okay, that was quite the deep dive we took today, wasn't
You
it?
covered a lot of ground.
We really did. We aimed to move beyond just, demystifying the basics of investing and instead take a much more comprehensive look at its core principles, especially through the lens of someone like you who's already engaged. We've hopefully shown that at its heart, investing is about strategically making your money work for you. It's about actively fighting back against the erosion of inflation and deliberately harnessing that incredible power of compounding over the long term.
Getting your money to grow in real terms.
Exactly. We unpacked critical terms like stocks, seeing them not just as blips on a screen, but as tiny pieces of ownership, dynamic claims on a company's future success, potentially offering both capital appreciation and dividend income.
Right. And bonds, too.
Yes, understanding bonds not just as loans, but as debt instruments with specific features like maturity dates, coupon rates, and yields, offering a different risk-return profile, often focused more on income and stability.
Contrast is important.
Very. We confronted risk head-on, didn't we? Differentiating between that company-specific, unsystematic risk and the broader market's systematic risk. And crucially, framing risk not as something to be terrified of and avoided at all costs.
Which would mean avoiding growth.
Right. But as something to be understood, acknowledged, and intelligently managed. Primarily through robust diversification.
Not putting all those eggs in one basket.
Exactly. Spreading investments across different asset classes, industries, and even geographies to build resilience. And finally, we walked through those 5 actionable steps to actually start building wealth.
The practical roadmap.
Yeah. Committing to regular, consistent saving, no matter how small. Embracing continuous learning as an ongoing process, cultivating immense patience, thinking like that tree grower, persistently practicing informed decision-making, and vigilantly avoiding those tempting but dangerous easy or fast money schemes.
Slow and steady wins the race.
It really seems to in investing. So the hope is that you now possess not just a basic understanding, but more profound, more nuanced, and genuinely actionable foundation. Knowledge that honestly many people shy away from, but that you've now explored efficiently and thoroughly.
And crucially, this isn't just abstract theoretical knowledge to file away somewhere.
No, it needs to be used.
Exactly. The real power of everything we've discussed today lies in its potential for real-world application, how it can actually transform your financial future. These concepts, consistent saving, informed choices, long-term patience, smart risk management through diversification, They aren't just dry financial principles.
Their habits.
They are foundational habits that, when you cultivate them with real intention and discipline, can profoundly alter your financial trajectory over time. The very fact that you engage with this deep dive, that you listened all the way through, it's a testament to your commitment to learning and growth.
Which is maybe the most important starting point.
Honestly, that commitment is arguably the single most valuable asset you possess as you navigate this ongoing investment journey. So let's build one last time on that beautiful analogy from the source material, the idea of building wealth being like planting and nurturing a tree. Let's leave you, the listener, with a thought-provoking question to mull over as you continue your path.
Okay, ready.
If building wealth truly is like planting that tree, requiring that initial seed of knowledge we've discussed, and that consistent watering of regular savings, then looking ahead, what kind of financial forest are you ultimately hoping to cultivate for your future?
A financial forest. I like that.
Is it intended to be a dense, protective forest, focused primarily on security and stability? Is it meant to be a vibrant, sprawling forest, optimized for maximum growth and opportunity? Or perhaps a diverse, resilient, multi-generational forest designed to provide shelter and resources long into the future, maybe for your family or causes you believe in?
Different goals require different types of forests.
Precisely. And critically, once you have a clearer vision of the forest you're aiming for, what further soil improvements might be worth exploring next? Maybe that means gaining a deeper understanding of specific asset classes beyond just stocks and bonds, perhaps real estate or alternatives. Maybe it involves developing new economic insights, perhaps into global markets or technological trends. What knowledge or skills do you need to acquire to ensure that your unique financial forest not only takes root and grows, but truly flourishes, thriving robustly for whatever purpose you envision for years and hopefully generations to come?